Hello everyone. Welcome to my video series on financial accounting. For this first video, we'll cover the basics of what accounting is, as well as the principles and assumptions upon which the discipline is based. Before we go any further, if you're watching this video, I'm guessing you're taking an introductory financial accounting course at a college somewhere, or maybe even a high school. If you're the type that has trouble learning by reading, these videos will likely help. Please regard them as supplemental to your course instruction. They probably won't take the place of attending class, studying your textbook, or doing your homework. That said, you can watch them before reading your text to better understand the material, or refer to them during or after reading for clarification on any confusing topics. Furthermore, maybe you're riding a bus to school or work, running on a treadmill, or doing some other task that lends itself to watching videos. In that case, you can use them to reinforce what you've just learned, or maybe even review the material before an exam or a final. My point being, please continue to do the stuff your instructor expects of you. That aside, let's get started. If you haven't even opened your textbook yet, you probably have an idea that accounting has something to do with money, and you're right. Specifically, accounting is the discipline which communicates business events and transactions to interested parties. What does that communication entail? First, we're going to measure the transaction, specifically as a monetary amount. Secondly, that transaction we just measured, we're going to record it in our accounting information system. As we'll see later on, this is when we'll book our journal entries, and those journal entries will have effect on our account balances. Finally, we'll report the results of those transactions. This is when we'll build our financial statements on a monthly, quarterly, or annual basis. Now, about those interested parties. We can classify them into two groups: internal users and external users. Internal users consist of people like executive management who want to make sure the company is profitable and in good financial health. It also includes department managers like R&D managers who need information about projected costs and revenues of new products and services. Purchasing managers who need to know what, when, and how much to purchase of particular resources. HR managers who are concerned with payroll liabilities, as well as employee benefits, performance, and compensation, and plenty of others. We also have sales staff who want to ensure the company is garnering a healthy revenue inflow. And of course, there's the internal finance team, like staff accountants and internal auditors. The former obviously being responsible for recording transactions, and the latter concerned with ensuring what was recorded aligns with economic reality. Our external users consist of taxing and regulatory agencies who want to make sure we're paying our taxes and complying with relevant laws and regulations. Investors who want to know whether we're providing them with a sufficient return. Creditors and lending institutions who are concerned if we can repay them if they give us a loan. There are also external auditors who want to verify that our financial information is accurate, as well as customers and suppliers, especially of the business variety. Businesses that purchase from us want to know that we'll be around to continue providing them with whatever good or service they need from us. At the opposite end, suppliers want to know that we'll be around in the future to keep serving them as their revenue inflow. And finally, there are unions who need data for negotiating wages and assessing job prospects. Neither of these lists are exhaustive by any measure, but hopefully you notice that internal users are those within the company and external users are those outside the company. For financial accounting, we'll be focusing on how we report to external users. Let's briefly go over some terms you may hear early on in your accounting course. The rules for recording and reporting financial information are based upon Generally Accepted Accounting Principles, or GAAP. GAAP aims to ensure that all financial information reported by a company is relevant, reliable, and comparable. Relevant simply means that a company is reporting the information that outside parties actually care about knowing. For example, An investor would want to know if a company spent $1 million to replace its fleet of work vehicles, but he probably wouldn't care what color they're painted. Reliability means that the information that is reported is an accurate reflection of economic reality. A company should not say that it has $3 million in debt obligations when it actually has $30 million. If you look into any of the accounting scandals from about 20 years ago in the early 2000s, you'll notice that a good many of them involve structuring debt so that it didn't legally have to be reported on the financial statements. As for comparability, that means that one should be able to compare information across companies. For instance, consider General Motors and Ford. If GM made a profit of $10 billion last year, while Ford earned $17 billion, comparing these amounts is meaningless unless the two companies are calculating their profits in the same manner. You should probably also know about the Financial Accounting Standards Board, or FASB. This is a private sector organization that establishes and improves GAAP. There's also the Securities and Exchange Commission, or the SEC, which is nowhere near as fun as the other SEC. This one is a federal agency responsible for enforcing GAAP, such as levying fines and bringing charges of violations. Lastly, you may hear a brief mention of the Public Company Accounting Oversight Board, or the PCAOB, sometimes called PCAOB. This nonprofit organization oversees audits of publicly traded companies. Audits are examinations of financial statements to ensure that they comply with GAAP. Now, let's dive into the accounting principles on which GAAP is based. Depending on which textbook you're using, some of these principles might be shortened or combined. But however they're presented to you, they hold true as the foundation for everything you'll learn and do in financial accounting. Our first principle is the measurement, or cost principle, as it's sometimes called. This principle merely states that we're going to base all our accounting information on actual cost. Cost is objective, so it's our best measurement of reporting the values of our assets and liabilities to all those users. For example, let's imagine we want to purchase a building. The seller is asking for $275,000. We offer $240,000. After some negotiation, we both agree to a price of $260,000. On top of all that, this building's assessed value for taxes is $270,000. At what amount should we record the building in our records? We'd use the $260,000 purchase price. That's the most objective amount to use for this item. What if a year later, its new market value climbs to $273,000? We'd ignore it. Leave the building in our records at $260,000 because its cost is the most objective valuation for it. Our second principle is the revenue recognition principle, which states that we'll record revenue whenever we earn it. It doesn't matter when we're paid the cash. It doesn't even matter if we're paid in cash at all. As soon as we've earned anything, we recognize a revenue. My quick and easy definition of revenues is money earned by delivering a good or providing a service to a customer. Anytime you do either of those two activities, you record the revenue regardless of when the cash or compensation is paid. Our third principle is the expense recognition or matching principle. This principle states that we record our expenses as we incur them to generate revenues. Effectively, we need to match our expenses to the revenues they help generate by recording them both at the same time or in the same period. Imagine a law firm buys some supplies. Nothing elaborate, just stationery, binders, legal paper, etc. You might think the purchase of those supplies is an expense. However, we haven't used them just yet to serve our clients. Only as we use those supplies in the service of our clients to generate revenues, that's when we record the expense. Lastly, we have the full disclosure principle. This principle says that any information a reasonable financial statement user would find pertinent should be disclosed. In the event that an item of information can't be quantified as a monetary sum, it'll be disclosed in something called the notes to the financial statements. We also have some assumptions of which to be aware. First, there's the economic entity assumption, which states that the owner and his or her business are separate and distinct entities from one another. For instance, if a business owner buys a truck for use in his business, the purchase will just be recorded on the business's financial records, which are completely separate from those of the owner. For all intents and purposes, the owner and the business are separate entities. Our second assumption is the monetary unit assumption, which states that all economic events can be measured and expressed in monetary units. For example, imagine one weekend an electrical fire breaks out on the top floor of a business's corporate office. After it's put out, there's obviously going to be some damage. Even if the appraisal process won't be as simple and direct as making a purchase, those damages will still be expressed and recorded as a monetary amount. You may also hear of the going concern assumption. This one presumes that a company or business has an indefinite life, absent information to the contrary. To put it another way, we presume that a business will keep conducting operations until it declares otherwise. The company will live forever, at least such is the premise under which we operate while handling its accounting responsibilities. Realistically, we know this may not be true, but we assume so until the owner states to the contrary. And finally, we have the time period assumption. This one states that the company's life can be broken up into sections of time for reporting purposes. Piggybacking off that last assumption, we presume that the business will exist indefinitely, but we can take that indefinite life and divide it into years to report activity on an annual basis. We can even look at a single year and divvy it up to build our reports on a quarterly or a monthly basis. That concludes a very brief intro to accounting. Come back next video where we'll cover the accounting equation. If my videos are helping you and you want to return the favor, you can leave a thumbs up. If you have any questions or suggestions as to how I can improve, leave them in the comments below. If you really want to help, temporarily subscribe to my channel. Not forever, just for however long you're taking your accounting course or courses. Finally, share my videos with your fellow classmates and even your professor. I'd like my videos to help as many students as possible, and I wouldn't mind getting some input from contemporaries. Thank you once again, and I'll see you in the next one.